Good afternoon, everyone, and welcome to Stock Market Today for Monday, March 3rd. It's Alissa Coram here, and a bearish outside day downside reversal for the major indexes as tariff talk continues to spook the markets. And joining me now to discuss is my colleague, Justin Nielsen. Justin, sounds like we're back on defense.
Yeah, I mean, and look, you didn't have to read any headlines. All you had to do was just look at the charts, and that kind of told you the story of where investors were shifting money. So a lot of those areas that we were looking at earlier last week in the defense space, those were right back on our list today. So we'll take a look at Coca-Cola, Altria, and T-Mobile.
Wow, that is defensive. All
That's
right,
right,
we'll
exactly.
take a look at those stocks, but first let's analyze the major indexes. The Nasdaq Composite down 2.6% by session's close after an attempted day two rally attempt to kick off the day, but got turned away, and we're now at a key long-term level once again. Meanwhile, the S&P 500 down 1.8% on the day, getting rejected at 6,000 in the 50-day line. Here's a look at the Dow, down 1.5%. Also, big downside reversal here, and small caps got hit really hard, Justin. More damage here with the Russell 2000 looking pretty bloodied, down 2.9%. So this is not what we wanted to see after Friday's upside reversal.
Yeah, I mean, look, on Friday, we were talking a lot about what this reversal looked like, but one of the key points is you have to manage your risk, as always, even more so if you're trying to play off a bounce. There is kind of like that level. This is where you know you're wrong. And if you ignore when it goes below that, you do so at your own risk, because look, we could bounce here. We're still not that far below the 200-day moving average line. But what you have to be a little bit more concerned about is how low can we go? I mean, you showed the Russell 2000 and the destruction that's been there. If you were, taking a look at any of these rallies or bounces or levels of support that it just went right through, and you decided to ignore it and just wait a little bit longer to see what happened, that just meant you were losing money. So again, it's no problem to, if you're going to be, sneaking in a little bit early. At this point, we are waiting for a follow through day. Remember, that's Friday was the rally attempt, day one of a rally. The follow through day, we have to wait until day 4 or later. That's kind of the orthodox way that we were talking about on Friday. We didn't get it. We undercut the rally. That means you start all over. And if you were trying to play kind of into that strength that we saw on Friday, this is a day where it's telling you that it's not ready yet.
Yeah, absolutely. And my style is to wait to see a little bit more evidence of that strength. Let's see if we can string together a couple of up days here. But for now, it does just seem, even with a potentially long-term bullish backdrop, in the short term, there are a lot of concerns that investors are getting spooked by.
Yeah. And again, headlines, uncertainty are always things that do affect the market. But one of the things about Friday's action was how it kind of shook it off. That didn't happen today. So you have
Mhm.
to adjust and react accordingly.
All right. Well, we'll have to see. In terms of next levels for the Nasdaq, it does seem like if the bleeding continues around 18,000, seems like a key area here, Justin. The S&P 500, meanwhile, has held up better,
Mhm.
but still not a good look to it here, getting rejected at that 50-day line and the 6,000 level.
Yeah. So again, you would like to see a little bit of follow up to Friday's action, and it didn't have to happen today. It's not like we had to start rip roaring back to new highs, but you certainly don't want to see the lows get undercut because then it's kind of look out below. But that 57.73.31, the January 13th low, is certainly an area of interest at this point. So that's the next area to watch, and then beyond that, you're looking at the 200-day.
Okay. And then let's take a look at blue chips. Uh, they don't look too much better here, Justin.
No, and for as much as you can say, oh well, these are kind of your stronger stocks. There's enough of a kind of technology bent and everything else. That I mean, this was just coming down along with everything else, coming up
Mhm.
above its 50-day moving average line on Friday, making some progress above its 21-day moving average line, and then just getting turned away. There really was very little spared except for those defensive areas where people go to hide.
And as Ed Carson always likes to say, relative strength can still mean absolute weakness. So,
Absolutely. And so you might be not coming in as much, or even if you're playing defense, some of these things were going up, but you've got to imagine that you're not going to be getting as much of a gain as you would in a good market where growth is working.
yeah.
So you're kind of risking a little bit more for less return, and that's not usually the way we want to do our asymmetric trades in our favor.
Absolutely. So it seems like in terms of game plan, this at this point, light exposure. If you tried on stuff today and it didn't work, triggered your stop, got to back away from that. And in the meantime, while we're waiting on a rally attempt and a potential follow through day, a change in the tide, we want to see what stocks are showing that relative strength, what's setting up, and what's looking good underneath the surface. What are the leaders doing? Because those are all clues to help us figure out what this market is like, and if it can be tradable.
Yeah. And one thing I would also say is we talked a little bit about RSP and how good that looked on the equal weighted side. This was looking pretty good intraday, getting well above that 50-day moving average line, starting to make progress. But this kind of tells you that most stocks, where most stocks are, at least on the
Yeah.
S&P 500, QQEW, also not a great look for this one. So again, no matter how you slice it, and one of the things we were talking about on IBD Live this morning was FNGS, which seemed to be very early on be taking it on the chin, even when RSP was doing
Right.
pretty good. So it just this was bringing the indexes down, but as RSP and QQEW, the equal weighted indexes show, there just really wasn't much that was working.
Right. A quick look at the 10-year Treasury yield. We've been tracking this pullback and another decline here today. So, what's interesting is at one point we saw this providing some relief to stocks, but not right now. It seems like bond market investors have their own concerns.
Yeah. So, I mean, again, this is where a lot of people will look at the 10-year treasury simply for that relationship, that correlation. When the yields are going down, it tends to be a little bit better for stocks. But at a certain point, sometimes those correlations just go out the window, whether it's recession fears or anything else that can kind of come in there to spook things. You can get those correlations off. And so at the end of the day, while it's okay to look at the 10-year treasury yield and these other indicators, I look at them as being secondary. You have to look
Mhm.
at the price action of the indexes themselves to determine what's really happening out there.
Right. And for me at this point, it seems like I'm using this more as an economic indicator, economic
Mhm.
sentiment kind of indicator versus a stock market indicator. Because, if you are, looking for a loan or a mortgage, you definitely want to see those interest rates coming down. But we'll have to see where it goes from here.
Yeah. Well, now one of the areas that does tend to be defensive in nature that was seeing a little bit of a, better action today was XLRE. That was actually of your sector spider funds. That was the best performer. And so this one has been in a big base, but it has been kind of trickling up as you see that 10-year treasury yield going down. So relative strength on this has been doing, pretty well. And it looks very different from most of the indexes.
Yeah, and we looked at a couple of individual names on IBD Live, Simon Property Group. There was another one that we looked at, Justin. It's slipping my mind, but
American Healthcare,
yeah.
AHR.
Yeah, okay,
Yeah.
that's what it was. So AHR we looked at and
See, I was
SPG.
paying attention.
There
You
you
were
go.
trusting me,
We're the
weren't you?
best. Yeah. So there are a couple individual names there for the watch list in the real estate area. Let's take a look at XLP consumer staples because, as we know here too, very defensive area. So when you see this outperforming, another data point there in terms of the risk off tone to the market.
Yeah. And remember, we did start out on kind of pretty positive note today. I mean, the NASDAQ composite was up almost 1%. It was up 0.75%. The NASDAQ 100 was up nearly 1%, and the S&P 500 was up about 0.5%. But that really kind of turned, and you can kind of see if you look at XLP, how XLP started. XLP started, kind of down, right? It didn't look that great, but then it kind of got into better shape as the day wore on.
Yeah. All right. Let's take a look at gold and the new gold. So GLD, this is your flight to safety, classic flight to safety asset here. GLD up 1.3% on the day, had an 8-week run, a little bit of a pullback, a little bit of a breather last week, but now up again. So it definitely seems like investors are still very much interested in the gold trade here.
Yeah, right back above that 21-day moving average line. And again, you had this one show that upside reversal. Not as strong as the indexes were on Friday, but this is kind of the follow through that you like to see. This is the follow up action you want to see. And I do have a position in this myself. I'm pretty light myself in the market, but this is a position that I've held on to.
Yeah, well, it's been outperforming the S&P going back to December, and then if you take a look at a weekly chart here, going back even further, I believe. So yeah,
Yeah, absolutely.
slow and steady wins the race here. I guess this is the tortoise in the market right now.
Yeah, and you see on that weekly chart a lot of those blue shaded areas. There's a lot of tight action. So for a lot of us growth investors, it can be like watching paint dry.
Yeah.
And I'll be honest, a lot of times I get bored with it. It's like it's just not moving. But then you kind of look
Mhm.
after a while and you say, oh well, this is actually not bad. I mean, it's not a 20% move in a week, but sometimes, as you said, slow and steady wins the race.
Okay. Well, the new gold I was referring to, of course, Bitcoin, volatile day to kick off the week after news over the weekend with more details about the new administration's crypto strategic reserve. And I believe on Friday, they're going to be having a summit at the White House. So there was a lot of excitement over the weekend and pre-market. I believe was up 9-10% or something to kick
Yeah.
off the day, but a pretty bad fade here, closing the day up just 2% after getting torched last week, which was another reason why we were saying, hey, this is a very risk off market. Bitcoin tends to be in that risk on category. So if you're seeing this come off, then another concern here potentially, or just to give you a sense of what's going on underneath the hood here. But a pretty bad fade today, Justin.
Mhm. And this is kind of, I think, the warning. Something that we talked about on IBD Live this
Yeah.
morning was, being very careful not to chase things. I mean, when this was up 10%, it would have been very easy to say, okay, all systems go. This has got to be getting back above its 50-day moving average line. This is the catalyst that Bitcoin needed. But again, it didn't last. I don't know why, but I can look at that chart and say, hey, this is not something that I want, to be involved with right now. And we talked a little bit about, okay, would a intraday chart potentially give you an entry? And if we look at the intraday chart on this, it just kept on going down, pause a little bit, down some more. And so that's not the direction we want to see things. So I think if you were looking at an intraday chart, looking
Yeah.
for an entry, that could have kept you out of this as well.
Exactly. That's where patience matters. I think also the context here matters. It's not like this was an upside reversal Friday at the 50-day line
Right.
and a breakout to highs here that held throughout the day. This was a chart that was already looking damaged headed into today. So not a perfect setup by any means. And you have the backdrop of this overall market
Yeah.
with the defensive tone, with us having heavy cash positions. So having a little bit of patience there, waiting for the right setup, maybe waiting, like you said, a little bit into the session to see if it could hold. And then, if all else fails, if you are going to be aggressive, like you mentioned, Justin, you have to manage risk and use your stops if the trade doesn't work out like you thought.
Yeah. And look, I like where this got support. So even though it was below the 50-day moving average line, it does make sense a lot of times to kind of look at the left-hand side. And you nailed it there, Ali. It's you go to the left, and it really was kind of at a level that gap up the low. It came right down to that. Seemed to be getting support. And look, it hasn't said that you're wrong yet, But if that's the level where I'm wrong, do I want to be really chasing it at today's highs? If that's how far I need to go down before I know I'm wrong, again, it comes down to risk management.
Well said. Okay, let's take a look at these defensive stocks. Look at Coca-Cola. So whereas we had the major indexes reversing lower, Coca-Cola here, KO reversing higher and closing at day highs up 1.6%. And this was already showing relative strength headed into this week as we saw that huge rotation out of growth into these more defensive areas. So Coca-Cola showed a lot of strength.
Yeah. And look, this is another one where if you look at the intraday chart, it kind of tells how the sentiment shifted from,
Pretty
again,
quickly.
yeah, when, exactly, when the indexes were up and it was like, oh, maybe this is getting some power, some
Mhm.
follow up to the Friday reversals, upside reversals that we saw in the indexes, and then as soon as that kind of started faltering, it was right back a whoosh to all these defensive names. And Coca-Cola, we already looked at the staples. Coca-Cola is one of those that tends to be a place where investors, especially those institutional investors that have no choice but to remain invested, they'll try and go to the things that are going to treat their money better in terms of not going down as much. So a big outside day here, a 1.5% gain, and kind of clearing a little area of, I don't know, you could call this a little teeny tiny handle maybe. But yeah, it's definitely a very different look. And again, it doesn't mean that you have to go out and start buying these things, just
Mhm.
because they're looking better and because the relative strength is strong. But what it does kind of tell you is a little bit of that sentiment. Where are investors putting their money? And right now, it looks like defense.
Right. Maybe, not a handle, maybe a soda pop top. I don't even know what those little things are called on the top of a little can there. But Justin, something else that's a good reminder for the audience is just because this looks potentially viable, like you said, maybe institutions need to hide here, but that
Yeah,
doesn't mean that investors have to trade this. You can if,
right.
if you want some exposure, but you definitely don't have to, right? Can you talk
Yeah.
a little bit about that?
Well, I mean, this is the thing to remember as individual investors, we don't have these mandates, that institutional investors have. Institutional investors, they typically will say, "Oh, we can only be this much in cash," and it's a small amount a lot of times. So they have to have positions in stocks, in equities, in they have to have that money working because no one's really paying them to just sit in cash, right? But as an individual investor, we have that option. Cash can be a position for us. And it's important to remember that if you're trying to protect your portfolio when it's just what Mark Minervini calls a hard penny environment, there's really no reason to stick your neck out on things that, you know, are maybe a 50-50 chance of working, or the volatility is so whippy that you could easily get, shaken out of things. It's much better sometimes to just stay in cash, watch from the sidelines, get your popcorn, and then when you start seeing those green shoots and things kind of turning, then you can start,
Right.
getting a little bit more involved. But until then, you don't have to go heavy. Cash is just fine.
Yeah. Okay. So from KO to MO, this is Altria Group here, Justin, up 2.6% on the day. Tobacco also screams defensive.
Absolutely, and again, this is the old Philip Morris. Altria is one of those typical defensive areas. You got a high dividend on this. If you go to the weekly chart, you can see that this has a 7.1% dividend yield. So sometimes people look at this and say, okay, look, if I can just get a little income and maybe not get too much of a downturn, that's okay with me. And so this is where sometimes people will do their hiding. And again, it's fine if you're looking at that 7% income and saying, hey, that's something I can really appreciate. That's much better than I could get from cash. You also have to remember there's still that risk that, hey, this can go down. And so if you have a stock that goes down 10%, what does a 7%
Yeah.
dividend do for you? That's still a 3% net loss. So keep that in mind when you're kind of doing these calculations. And again, you can't necessarily use our charts in this case because we don't adjust them for those distributions. So you do have to kind of do those that math yourself. But it is important to kind of keep in mind these aren't the ones that are typically going to do a lot for you. So it is okay to just be in cash and not have your money at risk when you
Mhm.
just don't have that much of an edge.
Exactly, because if you look at the relative strength line, maybe it's had a couple of periods where it's outperformed, but to take on that single stock risk while essentially just keeping pace with the S&P for the vast majority of time, yeah, that's something that you definitely have to think about. And I think in terms of our trading style, I actually like that we don't adjust the chart for
Mhm.
the dividends because most of us, the way that we trade is just like, oh, well, that's an added benefit to
Yeah.
get the dividend, not the reason why we're trading, looking at the stock price to make those buy and sell decisions.
And remember that, the dividend yield is something that you have to kind of get over a year's time. Could you imagine sitting in this for a year just to get that 7%? I mean, let's look at the monthly chart. Again, if you want to look at how this compares to the S&P 500 long term, this just doesn't do it. So it's a very important reminder that okay, you could maybe get something out of it short term, but you're not going to get that full yield. So kind
Mhm.
of what's the point sometimes?
Yeah, yeah, look for that outperformance plus yields,
Mhm.
if that's something that you're into. Okay, let's take a look at T-Mobile US. This one looks a little more growthy here, Justin. Seeing some accelerating bottom line growth and top line growth here as well. It's extended though. I mean, maybe potentially buyable on earnings or on the breakout a couple of weeks ago. Feels a little bit more like an add-on spot to me here with the stock up 1.2% on the day. What's your take?
Yeah. So this is one that we've been talking about actually for a while. I
Yeah.
think I brought this up on IBD Live shortly after earnings
Hmm.
because it had that gap up and then it just tightened up and kind of started, gave you an early entry right there after it broke above the high of the gap up. So, you could kind of argue that it kind of got a little shellfish where it kind of went flat here recently and maybe gave you another opportunity. But this is also kind of the benefit of being in something with an early entry because when it does something like this and holds above the 21-day moving average line, you do have a lot of cushion and a lot more
Right.
flexibility with how you handle it. One other thing I just want to point out on this is we talk sometimes about how much stocks move. We talk a lot about the ATR, the average true range. And right now, it might behoove you to kind of, if you are going to dabble, you might want to look at some of the stocks that have lower ATRs, the ones that just don't move quite as much because you have to remember it's not just about the upside moves, it's also those downside moves that you have to worry about. And an ATR only tells you how much it moves, doesn't tell you the direction. So
Hmm.
for T-Mobile, the ATR, the 21 ATR percentage is 2.39. So that's on the lower side. Might be an area where you're looking at those lower ATR stocks for opportunities if you decide to get into something. Otherwise, as we kind of drilled home pretty hard, I think cash is a position, and that's okay too.
Hmm. Absolutely. All right. And then a quick peek here at the weekly chart. It's definitely ramped up its relative strength over the last, 6 weeks or so, Justin. I think the issue probably was potentially around the time that it reported earnings, January 29th. It wasn't totally apparent the type of breakdown that we were seeing in growth stocks just
Yeah.
yet. It was shortly after the DeepSeek news, so maybe the AI chip stocks and the data center, cooling kind of names got hit, but otherwise, a number of super hot growth stocks were still looking good at that time. So, you know, do you want to go with the kind of sleepy T-Mobile,
Hmm.
at that point? So I think that's the trick, right? But I guess it goes to sort of the argument for diversification of leadership, right?
Yeah.
Maybe having some of the lower ATR, a little bit slower stocks that are still showing growth in your portfolio to mix those in.
Yeah. And look, if we just kind of end on the market note, again, as a reminder, we did kind of note that really this choppiness started on December 18th. That's really kind of what started it. And we had a lot of these cases where we would come down, we would come up for a couple days, maybe 3, 4 days, and then it was right back down. And that is a really hard environment to make money in, because a lot of times you're just not seeing things trend for very long. So look, if you're an active trader, you can get away with it. But if you're a trend follower, by the time you start seeing the green shoots of a trend, it's starting to roll over. And then by the time you start really kind of cutting your losses, it's coming right back up. So that can be the most frustrating of environments. And so recognize that on December 18th, when you have bad breaks like that, a lot of times those do require time. One of the things that we've been talking about. And it looks like that's certainly the case here. Now, where we go from here, I mean, look, the carnage could be over. This could be it, but it could also get worse. So instead of trying to project where we think it's going to go, I think we just have to kind of look at it day by day and make our adjustments as we see it happen. And that's, again, one of the things we talked a lot about on IBD Live today.
Yeah, really great words of wisdom to end on there, Justin. So I'm glad we circled back to that. Thank you so much.
Thank you.
And speaking of words of wisdom, hedge fund manager Jim Ropel is going to be joining me today live at 5 p.m. Eastern. Always love his perspective. Looking forward to getting his updated views on where we're at with growth, with Bitcoin, and the overall market. Is he cautious or constructive? We'll have to find out. Join us live at 5 p.m. Eastern on YouTube for our monthly market report show. All right, everyone. Well, that is it from us for today. We'll see you live at 5. And then the Tuesday crew has you covered tomorrow morning on IBD Live, starting 10 minutes before the opening bell. Investors.com/IBD Live for all the details on that. We'll see you there. And then we'll also see you right back here tomorrow after the close.